So there's so much talk about this market, and I really want to get an appraiser's perspective. So joining me today is Lisa Ziniel. Lisa, welcome. Thanks for coming today.
Thank you for having me.
So this market is just nuts. In my 16 years, I've seen nothing like the mismatch of supply and demand that we have right now. And I tell all my buyers that every property is going to sell at or above the list price. So the list price is not like the negotiable price. It's the starting price for what a property is going to sell for. As most of them are going to have multiple offers, they're going to sell well above the asking price. And so this is really difficult, and it must be very challenging for appraisers to find comparable sales, and just to do an appraisal in this market must be tough because everything that sells today doesn't close for another 45 to 60 days. So it's like we're always chasing the tail of the market. So how are appraisers dealing with this new market?
It has been a challenge, I'm not going to lie. The nature of the appraisal process itself has always been reporting historic data. So we've always done the same process. The difference today is we're hedging so far to the future. I think the biggest dilemma we've identified is like your list price was kind of like the beginning of negotiation or advertising. And then there was negotiation that was happening within that parameter. So from an appraisal's perspective, to demonstrate something above list as value is kind of a novel conception on our it's a novel thing on our end to begin with. Our process hasn't changed. Bank regulations haven't changed. The standards are all the same. Our goal is to actually report the market. So the historic data of the comparable sales, that's what establishes the value. So your list price and then above, it has been extremely unusual to our markets, especially in past crazy times, of years ago, like you were referencing. But, currently we're still doing the same thing we've always been doing. It's just more challenging because of, like you said, the competition within price, sales offers exceeding list to guarantee sales. All these things that are happening have never really happened in our market before.
And that's the biggest thing that I question the most. The two variables that are so tough for you, that must be so difficult, is that, how far back can you go on sales? Because, usually you can use something, 6 to 12 months, but can you even use something 6 months ago now? And then there's the other issue, which we're at the lowest supply we've ever had.
Right.
So how are you finding any comparables when there's nothing to find?
So if I think it's important for you to remember that we're using the properties you've sold recently as comparable sales. So that's where your dramatic increase is coming day to day, month to month. We're using those most recent sales ideally, and with a limited supply, that's the best that we have. So if you're doing a mortgage lending or you're doing an appraisal for the purposes of a sale, Fannie Mae's guidelines apply if that's the case for the intended use of the appraisal. If they're doing a loan for a mortgage, Fannie Mae allows up to 12 months. And like you're saying, 12 months ago now would be May, which would be the beginning of this whole trend that we've kind of notably seen. So ideally, the most recent sales are the best, but we can go up to 12 months. I think we have some tools actually that we could use if you're using dated sales, or not dated sales, but older sales. So like there's a market conditions adjustment. So an appraiser may reflect back on the analysis of the sales, identify the rate of appreciation that has happened over the last 12 months. It's kind of insane to imagine that there is a rate of appreciation over a 10-month period or a 12-month period, but there actually is. The best way to identify that is to use a recent property that is just sold or under contract that sold a year ago. That's the most discernible way to identify market appreciation, because it's hard to take a general price range or a general Iowa City growth rate, that, and I know NAR publishes statistics for, appreciation and growth, but that doesn't apply to every property across multiple price ranges. Right. So the best way to demonstrate within an appraisal process is to have a comparable property that has sold within this crazy time, within the last 12 months, which actually has been happening, and then analyze what it sold for last year. So that rate of change would be a demonstration for support for a market conditions adjustment within that transaction. But I really think it depends on each transaction and then the data available for that price range. But that is one tool that we could use to kind of keep up with market it currently. And then, of course, analyzing comparable listings and pending sales. That's the other change I think we've experienced. It's more important now to understand where we are in the active market with supply, with contingents, and with everything that's available for sale now in the analysis of the transaction at hand.
Yeah, and I think that's an important point, that there's different market segments for each price range and just segments in general. And so one of the segments that must be tough for you to do is shifting into new builds, which arguably is the metric for what we price resales on, is what is the cost to build new. And I would say that variance is like the lowest it's ever been between the two. But new construction's been hit so hard because labor and supply chain issues and the cost of everything from material to labor has gone up. And so one of the tools that you use to price resales or to price new construction is one of those three methods, is the cost approach, right? Is that what you use for new builds?
Yes, we do. We actually the cost approach to value is required because it is a necessary approach, or it's an applicable approach to value in new construction. The problem that we experienced in the industry with the cost approach is that Marshall and Swift also, that's our valuation parameters that we use. So the Marshall Swift numbers.
That's a system, or like what is that?
It's basically, it's a service that keeps up with industry cost measures, cost of materials and such. And then they have regional and local multipliers that are applied within your area to keep up with national building standards or prices. So what we experienced in the beginning was that the multipliers and the cost figures, if they're not updated periodically to current costs, there's a deficit of cost versus actual construction costs. The standards of those numbers have to be reflected in most current terms. So if your figures are lacking, as we experienced they were, because the increase in costs were so dramatically fast and then influenced by multiple things, those factors there's a deficit of information, essentially. Then you have the regional local multipliers to kind of bring it up to code. Those figures have been getting better. So we are a little more accurate, I think, in the last probably 6 months than we had been in the beginning of this whole craze. But the cost approach definitely is relevant in new construction. However, there's, for identified reasons, if the multipliers aren't accurate, if the figures aren't accurate, your value is not going to be accurate. Right. And so if there's a deficit there, it's really not a reliable replacement for the market approach. So your sales still speak volumes because it reflects more of what's going on in your marketplace rather than the cost estimates that could be skewed on the other side. So for like existing construction, the cost approach is less reliable because it's not factoring in depreciation. So there's other lacking figures that affect the outcome of the number and then the reliability of it. So your sales approach ultimately is still going to be the best demonstration for the appraisal process and the valuation process.
Interesting to know how you approach it differently on the new builds. So many analysts are saying that it could be like even a decade before we see some like reprieve from the supply chain crisis and costs maybe normalizing. I mean, what is normal these days? And potentially even coming down a bit. What do you see this as affecting the long-term real estate market?
Who knows? I wish I knew. I'd be very wealthy if I did, but we don't know. That's the thing, that our job is to demonstrate current trends. So while, we would all like to look into the future, we don't know, but we do know with certainty how our market has behaved in the last 12 months or in the past. We do know where activity levels are currently. And that's what we are supposed to be reporting on, is the current market, because
Right.
we're, our
'Cause you're a
intentions are,
historian. You're not a
yeah,
DeLorean going to look for the sports almanac.
exactly, exactly. And you have to, I think the important thing is to remember, what is the purpose of the appraisal? The purpose is defined in each assignment. And if it's
Yeah.
for mortgage lending or consultation, it has multiple purposes. So that's also important to remember.
Interesting. So one of the third methods that you use is the income approach, which is predominantly for like landlords or income property investments. Are you seeing a lot of those now, or investors kind of shying away now the prices are coming up?
Honestly, we've seen quite a bit of activity in single family investment properties. I
Hmm.
know I've been told by our commercial appraisers that the apartment buildings have been fairly active in the last 12 months.
Interesting.
I think some of the insight that we've kind of shared within our office is that people have had cash. COVID hit
Hmm.
in a way in multiple facets. So if people were less active, staying home, have more cash reserves in some cases. So they have money to invest now. The real estate market became active. If you have some cash to bring to table, in fact, for a deficit of appraisal versus offer, or an investment into an investment property, I think that has something to do with the interest in investments, and not to mention the interest rates have been low.
Hmm. Well, and the rental rates now are going astronomical. I mean, they're just so high. I mean, they might be appreciating faster than the purchase price of homes. So
They are.
that
Rents are keeping up with prices, I do believe.
I read a survey. It sounded like they're going even higher, but
Yes,
it's
I've
definitely
heard
putting
the
a
same.
squeeze. So that's interesting. Well, are there any changes that the appraisal licensing committee is talking about that they're going to need to do to help appraisals and appraisers?
I think by profession, our industry has been losing appraisers over the last so many years. I couldn't give you an
Ugh,
exact number, but I have heard upward to like 40% decrease in licensing.
wow.
I know our standards have become more stringent over the past 10 years.
Hmm.
There were many changes that took in effect after 2010, 2009, with that economic crisis that happened. There was Dodd-Frank legislation on the banking
Hmm.
end. There was a tightening on the appraisal licensing and qualifications. So with those changes, and the mentorship process, there's been a lot of industry changes within licensing over the last 10 years. There's also, coupled with the retirement of an aged profession, I think we've kind of found that to be in accounting for some of that decrease in licensing as well. So there have been some changes, which ironically hit with the market opposite, inverse.
Oh, that's too bad to hear that you're needing some more labor force in that area. It seems like everybody does, but it sounds like at 40% you need a lot. So
Yeah,
that's
that's
going
been
to be
yeah.
challenging. Well, tell me a little bit about the biggest question. And I know you don't have a crystal ball, but a lot of people are forecasting that we're in a bubble. I don't think so. I mean, the supply and demand levels are just so different than every other bubble that you and I have experienced in the past. So, what are your just shooting from the hip thoughts?
I think that I don't know what we call this, to be honest, because the last time that we hit a crisis level trend was in 2008, 9 or so, where, interest rates were progressively coming down. So we had more purchasing power,
Hmm.
and it was more of an equilibrium between buyers and sellers.
Right.
But everyone was going up in price range, construction was booming. So, the market was kind of going up together. I think right now we are at a point that we've never been at, because we have prices that are driving the values, but they're sort of unbalanced, because I think that people are listing a home with the understanding that they're going to get a premium
Hmm.
for their property, and then they still have to relocate someplace else. And we have demand from people coming in. We're a university town. There's a lot of factors that are at play on both sides, but I think we're sort of unbalanced. And I think that when the demand will stop is when the interest rates affect purchasing power.
Hmm.
So I think that's one factor. I've heard a lot of conversations on the markets, but we've never really talked about what demand is truly affected by. And it's, of course, affected by interest rates. So a sudden increase in interest rates may dramatically impact the buyer's potential. and it may change things rather quickly. But the same with new construction. How would a lack of demand affect new construction? People are paying these prices because we're demanding housing. We have the ability to pay for those prices with lower interest rates. If the interest rates go up and the demand falters, that's where I think we're going to see an impact on the immediate market.
Yeah, those are all good points. And the question is, how high does the Fed need to go to have a cooling effect? We'll see.
Well, how fast? I think it's also what we're not thinking about is how quickly, because a gradual increase in rates over the years has been assumed by all participants.
Right.
When you have a sudden increase, there's the psychological impact that increase has on buyers. And what does that look like? That's to be determined.
Good points. Well, finally, what tips do you have for consumers in this market that are looking for to do an appraisal? And a little bit, we need to plug you as well. So you do private appraisals as well as work for banks. And how would they get in contact with you to get your services?
We would have email is probably the best.
Okay.
It would be lziniel@rallyappraisal.com. What tips do I have? Just remember what the purpose is of the appraisal. It's if you're hiring for private consultation, that's one thing. If you're looking to get a loan for a mortgage and we have to go through all of the discussed processes that don't change from market to market, we're an independent third-party unbiased opinion that's working for the bank to verify market value on that property. So we're doing our best with the information we have, with the processes in place that we're federally regulated by. And, it's a case-by-case situation.
Very good. Well, thank you so much for joining us today. You're an expert at your craft. I always enjoy listening to you and finding out what's going on in the industry. And I know you have probably a lot of appraisals yet to do today, so we'll let you go. But thanks again, Lisa.
Thank you for having me, Adam.
All right. Have a great day.
You too.